over half of venture funds return less than 1x. And, on a risk-adjusted basis, even being in a top quartile fund is not amazing based on the fact that venture investments are not very liquid. So I think that most VCs don't have product market fit, and the model is not that successful. But if you're really good at it and you're a top 5% fund, then it is very successful, and it is an incredible, asset class to be in at the end of the day. If they want to get exposure to things, especially when you're in a lower interest rate environment, then they need to diversify away from many of the other asset classes. And so oftentimes, LPs might have capital in public equities, in real estate, in debt funds, in private equity, and venture capital is a subsector of private equity. But you're really trying to get exposure to what's next, because hypothetically, valuations of $15 or $20 million for ideas. There's no underwriting that. Back in the day when Steve Jobs was raising capital, I think he raised like a $300,000 valuation initially. He sold a third of his company for that, for Apple. Now if a company has to burn $1 billion to, get to product market fit, you better be damn sure that there is very little. I have definitely met founders that have done it for the money, and I think it's totally fine.
Hey Jason, how are you? You're doing well?
Doing well, man. Doing well.
So I think let's just get into it. So before we begin, who is Jason? Why you?
Yeah. So I'm a venture capitalist, general partner over at Primary. I've been an investor here for the last, almost 5.5 years at this point, coming up on 6 years soon. Live in New York City, and focus on seed stage investing, mainly in companies within proptech, SMB software, and then consumer.
So I think that's an incredible introduction. And you got into startups when you were very young. Your mother chartered you in the city. So how did you really get into startups?
Yeah, so, I grew up in a family of entrepreneurs, mainly small business owners, not people that were raising venture capital. Matter of fact, like the people in my life did not like venture capitalists. They turned venture capital dollars down. But, the combination of being around my family who were running businesses at the time, and then I also grew up with something called primary immune deficiency. And when I was really young, I was pretty deeply involved with something called the Jeffrey Modell Foundation. And as part of that, I used to travel and help with different, fundraising things and medical school openings and different things. And I was always around two different types of people there. I was around doctors who were, wonderful and kept me alive. And then I was around entrepreneurs who were donating, their time and money, to the organization and really giving back. And I always felt like for me, that would like deeply, deeply resonated with me. And so the idea of being able to, go out and build something special and be able to donate my time and money was one thing that definitely inspired me. And then seeing the work ethic and how fulfilling it was to start your own business and really grind it out, being around my family, something that certainly inspired me and ended up getting me involved in startups in the early days.
What does your family think about VCs now?
I think they've come around to it. My uncle, once upon a time, who's the one that doesn't love VCs, said to me, I wouldn't even recommend, this was after my first startup, by the way. He was like, I wouldn't recommend starting a company. And again, he's like, I'd recommend going into venture capital because you're a lot more diversified. So yeah, I think venture might be a little bit lower risk. It certainly is lower risk per se. But at the same time, like it is a grind, it is high pressure, especially if you want to do it the right way. And the right way meaning like, we have a lot of responsibility to the founders that decide that they want to work with us. And we also have a lot of responsibility to our LPs, and our LPs are not just like random rich people, all the time. It's a lot of nonprofits. It's a lot of retirement accounts for, city and state employees. And it's really impactful and nonprofits as well, where every dollar of return that we generate and send back home to these LPs has an impact on the lives of people who are sick, people who are, from, underrepresented backgrounds and backgrounds, with growing up in poverty. And if we can make a difference in those people's lives, I think that also helps drive us as well.
That is an interesting point. I think a couple of people that have talked about this that have never really gone in detail about the specific LP thing that you talked about. Why do you really think is the venture model, VC model? Why does it have PMF?
Yeah, I mean, I have a hot take, which is it's not successful. I think over half of venture funds return less than 1x, and on a risk-adjusted basis, even being in a top quartile fund is not amazing based on the fact that venture investments are not very liquid. So I think that most VCs don't have product market fit, and the model is not that successful. But if you're really good at it and you're a top 5% fund, then it is very successful, and it is an incredible, asset class to be in, because you can generate, 5, 10x, 15x, 25x, even more type returns. The reason why I think LPs like it is it provides them with diversification at the end of the day. If they want to get exposure to things, especially when you're in a lower interest rate environment, then they need to diversify away from many of the other asset classes. And so oftentimes, LPs might have capital in public equities, in real estate, in debt funds, in private equity, and venture capital is a subsector of private equity. But you're really trying to get exposure to what's next, because hypothetically, early stage companies, new technology waves could disrupt a lot of your public equities portfolio. And so you kind of want to hedge against that. And venture is one way to do that. And it's also another way to diversify away from that.
But talking about it from founder point of view, why do founders raise money from VCs? I mean,
yeah. I mean, oftentimes, you think about a lot of the companies that are getting started, and a lot of them have trouble getting started without capital. Because a single person might have, an idea, and that idea might require different skill sets and different people to get that idea off the ground. And those people might not be available for free. And additionally, there might also be other resources that are needed, for instance, like inventory or lab space or, hardware and development costs. And, that's where venture capitalists come into play, is when it costs a lot of money to get something off the ground. And, founders need that capital to get the resources necessary to go out and prove certain things, to reach certain milestones, to then continue to scale the business. And so oftentimes it's when setup costs are really high, or when, the barriers to entry might be a lot of capital, or you need to get to scale in order to create barriers to entry.
Can't founders directly raise money from LPs? Where have the middleman?
LPs don't have the infrastructure really for that. You think about how large some of these endowments are, and it's like the team sizes of these institutional LPs, they can't handle, writing $1 to $2 million checks or $3 or $4 million checks while also deploying, $10 billion checks over, into this other bucket. So I think the skill set is just, fundamentally different. The sourcing is fundamentally different. The networks that you need to tap into, the underwriting is much, much different. And then the amount of time you have to spend with these companies. And so, I think if you're going to be treating founders the right way and you're going to be adding value, then you need to be doing this job full time.
Even go back to your last start a little bit about why do founders raise money from VCs? Why do you think is raising VC money better than loans, for example? Venture debt? That's a case.
I mean, loans aren't always available to startups. They're usually not available to startups. Venture debt won't be given to startups unless VCs are putting dollars behind it. So there's not really that option most of the time for people. Here in America, we have something called an SBA loan, which is for small businesses. And, those can oftentimes be challenging to get with just a business plan. If you're a startup, if you're buying a business, that's profitable. It can be a lot easier. But when you're starting a tech company, it's usually really hard. So oftentimes, you see one of like a few things happen. It's either like you go to venture capitalists, you go to accelerators, or, the historic way of doing it was what people called like a family and friends round. And they ran around town and, tried getting a family member or the person in their neighborhood to write a check or the person at their country club. And you cobbled it together until you were able to learn enough and prove enough until you were able to go raise additional capital.
How much of, in relation to this point, how much of it is really valuing the equity of the company? Do early stage founders really value the equity?
Oh, yeah. I mean, I think early stage founders value their equity a lot. It's why they like getting, valuations of $15 or $20 million for ideas. It's, there's no underwriting that. Back in the day when Steve Jobs was raising capital, I think he raised like a $300,000 valuation initially. He sold a third of his company for that, for Apple. Now, if you told the founder that you're going to give them $100,000 at a $300K valuation, coming out of any good school or whatever it is, doesn't matter how old they are, they'd probably laugh in your face as an early stage VC. So I would argue that they very much value their equity.
Why do you think that Steve Jobs not value their equity?
I think he did. Just all markets are efficient at the end of the day, right? So back then, there was probably not that many people who were writing checks into startups. Now there's a lot of people writing checks into startups. And so if all of a sudden the demand for startups is going up and the supply for that, is not increasing, and people realize that, an Apple that got invested in at $300,000 is now worth over $1 trillion, like on a risk adjusted basis, and your probability expected return, like it's a pretty freaking good investment. And so all of a sudden, more and more people flooded into the ecosystem, and that pushed prices up, which also enabled founders to raise more money out of the gates at higher valuations. Now, whether or not that comes back down, that's another question. I think it probably needs to over time in order to make the asset class continue to work. And I do think you'll see, a number of funds that go out of business, number of investors that retire, and the dollars flowing into the ecosystem will ultimately change. But, we are where we're at today because the markets are efficient.
How is the value of a company realistic? There is no set formula for it. What is it?
There's no, it's all, it's more of an art than a science at seed. In the later stages, it's much more a science, and you're underwriting future cash flows at the end of the day. But we usually think about it along the lines of like, how much capital do we need to put into the business to get it to a certain amount of milestones to then try to 3x our valuation between round over round. And if it hits those milestones, which are oftentimes, revenue, is there another investor that we know that would be willing to pay a price that would be that 3x step up on the valuation? And that's, it sounds so simple and like, and almost like dumb in a lot of ways. But, we now have, we look at thousands of companies every year, and we've invested in over 70 with, some pretty good success so far. And like, you look at how many people they need to hire, how much do they need to spend on customer acquisition in order to get to, call it 2 million of ARR. And then what does the next round investor believe that $2 million of ARR worth?
How should founders decide how much they want to raise?
How should they say how much they want to raise?
How do they decide how much they want to raise?
I hope that they would put together a plan on their side that sounds a lot like what I just said, which is, they're thinking about how many people do I need to hire in order to build my product, in order to sell and market my product, and in order to acquire enough customers where I will be able to get to a certain amount of revenue that more investors will want to either put money into the company or for me to get profitable.
You talked about getting customers there. This is something which was a lot of people would never really go into perfect answer. How should founders decide the CAC, customer acquisition?
How should they decide the CAC? It depends on the industry. I mean, at the end of the day, in a perfect world, right, you're going to have a payback period that is 0 months. You spend $1, you get $1 back right away on a contribution margin basis, by the way. That's the most important thing to think about. But that's usually not the case. So what is great, or what is good, better, best? I'll tell you what is the best, less than 6-month payback periods. What is, better, or which is like the next tier down from the best, it's between 6 and 12-month payback periods. And then what's, good or okay, it's like 12 to 18 months, payback period. But if you look at the public markets right now and in software businesses, B2B software businesses, there's a lot of publicly traded companies that are at scale and at, 24 to 36-month payback periods. So what I would tell you in terms of the number itself is it changes depending on the business model and what you're charging, for that product or that service. But what I can tell you is that on a contribution margin basis, you better be below 12 months and ideally below 6 months if you want to be raising world-class top-tier venture capital.
Why?
It's all about efficiency. How much money you're going to have to raise if to get to $10 million of revenue if your CAC is $1 million and your payback is 36 months versus if your, CAC is $1,000 and your payback is immediate. It's like a crazy difference. It's the capital efficiency of the business, which means the founders are not going to get diluted as much. The VCs are not going to get diluted as much. And it also defines the health of the business, because if you can't recoup your investment in your customer acquisition cost in a short period of time, then the return on invested capital, like the ROIC, oftentimes will be very low.
I'm curious, does that change with highly ambitious companies or relatively more ambitious companies?
Does what change? The payback period that we would be okay with?
Yeah.
At the end of the day, it all boils down to, what is the expected return? So if a company has to burn $1 billion to, get to product market fit, you better be damn sure that there is very little market risk. Like SpaceX. SpaceX knew that if they were able to build a spaceship that went to space and that had components that came back and landed that they could reuse, and that it was cheaper, that they could charge less, and if they charged less, that the US government and that private companies would probably want to buy, different launches. That did not have any market risk. It had all technical risk and all execution risk. And so what you could underwrite there probably was like, well, how much in contracts could Elon sign, if he's able to accomplish this? And how much cash flow can he generate? And what is that eventually worth? And do we think that it'll take 200 million, 500 million, or $1 billion to get there? And what do we think the probability of him getting there are? And people felt comfortable enough to continue to back up the truck. That, by the way, that didn't mean it was easy. Like, there were times where I know that team struggled to raise, and oftentimes a lot of ambitious entrepreneurs struggle to raise. And there's times where, investors have to step up and decide if they want to put their neck on the line and, their neck on the line for their partners and for their LPs to ideally keep something alive that will eventually yield a very strong return for them.
How should SpaceX is like a moonshot project. I'll talk about relatively that. How should a founder really figure out whether what they're building has a market risk or not?
I think it's a very simple thing to do. Go talk to customers. It's like, if you, when we incubate businesses now, I try to talk to 50, 100, 200 customers. The founders that I invest in, they've talked to, 50, 100, 200 customers, or they were the customer. And even if you were the customer, you probably should be still talking to 50, 100, 200 customers. if you're not talking to customers and you come in and pitch us an idea and you pitch me an idea, I'm going to tell you you're making a huge mistake. Not only are you making a huge mistake pitching investors, but you're making a huge mistake for your life, because if you ended up quitting your job to go work on something where you didn't want to do the work to figure out if anyone wanted to buy it, that's a bad, bad, bad way to get a company going.
How much of the founders who have given you great results as a fund, how much of their time went towards talking to the customers versus raising money?
I mean, founders who are great are not raising money that often. They're raising money once every 18 months, and maybe they're, meeting with an investor or two a week in the off time. But for the most part, they're like locked in on operating. And, similar to how Jeff Bezos talks about it, like, you just need to be customer obsessed. And the best founders are customer obsessed. They're talking to, customers every single week, if not every single day. They're building systems into their company when you hire people and when you, give people promotions that still keeps them very, very close to the customer and keeps their ear to the ground.
If founders become too customer obsessed in the future, do you think the latest stage VC fund will cease to exist and seed fund will be there?
I mean, if you don't need to raise VC dollars, you shouldn't raise VC dollars. But like, let's use software companies as an example. Most software companies aren't that defensible in the early days. So if you start a company, today, and that company sells an operating system, for restaurants, let's call it, and all of a sudden you have 10 customers. That's great. It's impressive. The challenge is that, like, I see your thing working, or some other person on the other side of the world sees your thing working, and they're like, I like that idea. Or maybe somebody from across town sees your thing working, or maybe somebody who's working at one of the restaurants who used it sees it working. And then, that person goes and they go to a venture capital fund and they're like, hey, like, I have this idea. I started using this product. I think it was really good. I kind of want to build it, but better. And I want to scale it faster. And all of a sudden, I'm going to go hire 100 salespeople to go sell the thing. You're in trouble, because they're going to be able to grow. And for every customer that they acquire, especially if it's locally, every percentage point of market share that they get, it's going to be super expensive for you to try to claw that back, because people don't switch oftentimes when it comes to certain things like software. And so I think that's where venture capital comes into play. If you are insanely ambitious and you really, really want to scale a company, then I think it's something that you should dabble with. But it's also just not for everyone. Like, I don't think most people want to build $1 billion company. I don't think most people have it in them to build $1 billion company. You need to evolve over time. You need to grow a lot, and there's multiple evolutions throughout the course of scaling a business. And you need to sacrifice a lot.
Like what? What do you need to sacrifice?
I think there was a saying. I was listening to a podcast about, the most successful founders in the world historically have died, still working and unhappy. And I think I don't think that's the case for everyone. However, people that are very, very good founders are obsessive, and they have a crazy sense of urgency, and they work really hard and a lot and for long hours and are really smart. And so all of these things, it's like the sacrifices you're making are probably coming, to other parts of your life, because you have a finite amount of time. So if all your energy is going into work and family, you probably don't have that many friends. Or if it's going into work and, friends, it's probably not going into working out. And, there's like different things. There's only so much you can do at the end of the day.
I touched on your last point about founders being smart. How smart should a person be to become a founder? Is there a barrier to that?
I think your ability to learn about things and learn from conversations and pick up concepts is important. I don't think you need to be a genius to be an incredibly successful founder. I think you need to have a good idea at the right time and in the right market. And then I think you need to move really, really fast. And you need to surround yourself with really smart people. And you should go and hunt down good advice. You should go learn as much as you can so you avoid all the mistakes that have already been learned. And as long as you're smart enough to do those things and you can be pretty damn convincing, you can raise money, you can sell stock, and you can sell people.
You talk about moving fast. A lot of people talk about moving fast. What does that really mean?
What does moving fast really mean? I mean, it's getting things done in a period of time that seems completely unrealistic, like when you first hear it. It's like, we backed a founder recently and he told me that he talked to 250 customers in 3 months. Well, there's 90 days basically in 3 months, right? So he basically talked to 3 customers a day, but like he was also in school and building the product and doing all of this solo. And so, when you see all the stuff that he was able to accomplish in 90 days, you're like, oh, that's fast.
But why did you really invest in it?
Why did I?
Yeah. Why did you invest in it?
I didn't. So I invested in him because a few things. Like, 1, he's incredibly sharp. 2, he moves really, really fast. 3, he can sell his product because he proved it already. 4, he can sell people because we always ask ourselves, would we ever want to compete against this person, or would we work for this person, for instance? And that was a yes. He's a great storyteller, and he's young, he's hungry. And the bigger thing though, on top of all of those things is the company he was building or is building, which is in stealth mode, is a product that I believe is inevitable. And I looked at, the market. I spoke to potential customers even before I met him. And I thought that the market was amazing. And you take an amazing market and you add in an incredible founder, that's where the magic really happens.
What really makes an amazing market?
What makes an amazing market? Oh, man. There's a lot of things that make an amazing market. But at the end of the day, I would say a strong market pull, meaning like customers really, really want something. It's a massive market with large gross margins, like fat gross margins, not a ton of competition, ideally, some fragmentation, going on in the customer base. I could go on and on and on and on, but usually I like to see a strong why now. Like, is there something that from a technology perspective and an industry perspective has changed that was not around, over the last however many years, that is now enabling this opportunity to exist today?
How, if you do find an incredible market, how far do you really think about, how far do you look along the lines of that market before investing in a company that is in that market?
Well, there's 2 different things, that we do at Primary. I mean, one is each of us are specialists. So like, we're living and breathing in our market all day. And so we're talking to customers, we're building our own internal expert networks, we're building networks of potential customers. We're asking those people, what are their pain points and, what are they looking for? And we're identifying where the largest budgets might be for things to improve or change, et cetera, in the very near future. And when we are, then we're like, trying to hunt down and map out the market of those companies, that might be playing it. That's certainly one way to go about it, which is a more thematic approach. The second approach that we tend to go through is a bit more of what I would call like, so there's like push and there's pull. Pushing is like the thematic. Pulling is more of like, we are sourcing deals. We hear about a founder working on a company in a market. We have a high level idea of the market structure already. but we want to make sure that we go and do our work because we haven't talked about that specific concept or that specific pain point with the customers. And, as a venture capitalist, it's your job to be able to get up to speed on markets very, very quickly.
How do you generate idea about the market structures?
I mean, market structures are something that I think a lot of people probably have learned in school. At least I studied it when I was in business school. I didn't go and get my MBA, but in my undergrad, and it's a lot of just desktop research. It's okay, how many businesses exist in that given market? How many businesses between this size and this size exist in that market? And you can literally go ask Bard or, ChatGPT a lot of these questions. And, if you're finding, I would make sure that you understand the different segments of the market. And then B, I would study the underlying businesses in those markets. Are they, companies that require a lot of, CapEx to build new, versions of the business? Are they companies that have good gross margins and strong EBITDA margins, or are they companies with low, EBITDA margins? Is it a business? Is it a category where you have a lot of businesses that shut down every year in a low success rate, like restaurants? That's a tough underlying category, because the underlying health and quality of an industry and market is really, really important. So I think you got to look into all of those things and figure out whether or not it's a market that you really want to be playing in.
What do you think really decides where the market really goes as well?
Incentives. At the end of the day, it's very, very simple. Or is it always that they want to make more money?
Yeah.
Provide better quality service, and they want to save time.
Incentives from both sides, from the customer side and from the company side.
Yeah, literally across the board. It's always the same thing. People want things better, faster, cheaper, or they want to make more money, deliver better service, and, do that in a smaller period of time.
How do you see that with emerging markets like AI?
So AI is the type of thing where if you can identify certain workflows in certain industries that currently are, for instance, I was talking about, if you see markets oftentimes that have very, very low net income margins, they probably have pretty low technology budgets and probably don't spend a lot on software. So historically, they've been pretty bad markets to sell software into. Well, if you can find a workflow in that market that represents a very, high percentage of COGS, then what you should probably be doing is trying to figure out a way to automate that, leveraging AI. Because if you do, now you're improving the business's gross margins, you're improving their net income, the owner's making more money, and as long as it's offering a higher quality of service, which oftentimes human error in a lot of these different markets is a major, major issue, then you're in good shape to be delivering an artificial intelligence product.
Do you think in markets that are growing so fast like AI, can bootstrap companies really win from VC-backed companies at the growth stage?
Sure, because I think every market is going to be growing incredibly fast right now within AI. So the other thing is certain businesses are just fundamentally easier to build now than they were historically that probably don't need venture dollars as much. And you look back, at companies, I think WhatsApp was always a very, very lean company, but it's massive. And I know they raise venture capital, but if you can figure out ways to generate revenue in the early days off your product and continue to feed your own growth, and to grow is not a human intensive thing, which that's an important thing to think about, right? if you require a lot of humans to scale your business on sales and marketing, for instance, then yeah, you're going to need to probably raise venture unless it's an unbelievably efficient business. But if you don't require that and there's not a lot of variable cost in the business, then you're going to be able to scale pretty efficiently and outcompete, or depending on how good you are, outcompete VC funded startups.
If you do look at it that way, do you think in general, as a founder, is it harder to build a VC-backed company or a bootstrap company?
They're both really, really, really hard.
Why?
Fighting the laws of gravity. Trying to fix an airplane while it's going to the ground. Like, you're creating something out of thin air and trying to convince people to take money out of their pockets and, give it to you. Or you're trying to convince people to take time out of their day and their lives to use your product. Like, human beings are very routine by nature. They don't like changing habits. So you're asking them to change a habit and you're asking them to pay for that habit to change.
You've been in the VC world since a very long time. How have you noticed do habit changes really come?
It's come very, very long way. The world is so much more competitive now than it was back in the day. Especially see like people are super collaborative. Everyone was writing 250 checks. People were sheep. They didn't like making their own decisions and getting their own conviction. I actually like today a lot better now because we can be independent thinkers and do our job, I think, the way that we should be doing our job. We can also generate better returns as a result of that. Also a market that's gotten more efficient because of information. Historically, when you think about it, there wasn't information about every single startup out there. You didn't know how many employees they had and how fast they were growing. And now there's all sorts of data tools that we can all use to flag, the most recent company that's growing super, super quickly. And then even if you're growing super fast and you're getting really well funded, there might be somebody on the other side of the world that hears about you now getting funded and growing super fast, and they might copy your idea. And so now your TAM is only the United States, whereas it could have been the US and Europe and, India and all these other countries. But now there's 5 versions of you all around the world. And so information is flowing insanely fast. And, people can access and learn about startups and best practices and, how to raise money and whatever else all over the internet now, all through podcasts like yours. And it's, leveling the playing field in a lot of ways.
Yeah, definitely. How do you think VC is changed over time?
How do I think
individual investors, people?
I mean, I've certainly gotten older, but I think at the end of the day, I think we've all gotten more competitive. I mean, we were probably already, a lot of us were competitive. I think that we've become significantly more data-driven, in our sourcing approach and style. And I think we've all had to start to become specialists more and more frequently. Because, if you're younger in your career, and you have not backed companies successfully before, and you go up against an investor that has been around the block, you're probably going to lose that deal, right? But if the investor that has been around the block is trying to go up against me in a, real estate tech deal, I feel pretty good about being able to go up against them because I've now built a network in that market. I know the buyers. I know how they think. I could probably introduce them to a lot of customers. I can probably introduce them to a lot of potential hires. I know the investors like the space for down the line. So it enables you to outcompete and compound your learnings. Whereas when this industry was less competitive and there were less people doing it, it enabled you to be a generalist and then go ahead and try to deploy capital.
Do you enjoy the competitiveness?
I love the competitiveness.
Why?
I'm a competitive dude, man. I've always been a competitive person. Like, it didn't matter if we were playing video games when we were kids or, any sort of sport. Just love winning.
But what happens if you lose?
Then I lose. It's I'm not happy about it, and I'll lose sleep over it, but it is what it is, and then I'll get over it. I'll wake up the next day and I'll try to improve and try to be better. I mean, I think that's what you need to do if you want to be one of the best investors in the world. I mean, it is a competitive market. You think about the people who are doing this job and like what they did before, where they came from, and it's like a lot of these people have advantages over you, and so if you're not competitive, then good luck.
Uh, what are you guys really competing for?
Returns. You need to see the best deals, and then you need to win the best deals. And when such a massive percentage of the returns in the industry go to such a small percentage of companies, you better make sure that you're in those companies.
Why do you think is that? Why do the massive returns go to a small percentage?
You tell me. Like, there are some companies that are structurally changing the way that the world works and in large markets, and it's one of those things where it just creates monstrous outcomes. I mean, Uber completely disrupted an industry. Airbnb completely disrupted an industry. Apple basically built an industry, And so when you do these things and like these outcomes in these markets are huge and you can build 30, $100 billion, $1 trillion companies, you think about how many $1 billion outcomes it takes to get to like $100 billion outcome. Like, it's a lot. So you want to make sure that you're in the $100 billion outcome, because even if every one of your partners at a fund of 10 partners, gets one unicorn that's at $1 billion, doesn't add up to, 1/10 of or it adds up just 1/10 of the $100 billion outcome.
Why do investors or VCs really not build companies to fund them?
Many of us have built companies. I started a company before. My partner Ben started a company before. My partner Sam started a company before. So a lot of us have started companies, and a lot of us have operated. And some of the best investors in the world have built companies and operated. We also do incubate as well, where we now come up with ideas, and we oftentimes bring founders in to, go and run with those companies. And often, a lot of times too, like investors who came from operating or came from starting companies and start investing might incubate companies and then go become the founder of that company, or might, invest in companies, then join that company. It happens all the time.
Yeah. You've been a founder before. You meet founders every day. You fund companies. Do you think should founders pay themselves?
For sure. If they can. I mean, you need to be so focused on your business that if you can remove other stresses in your life to an extent, like if you can't afford to live day to day and have a roof over your head, chances are you're probably going to be pretty stressed and not focused on your business. So I think you want to get people into a place where they are pretty grounded and satisfied, with some of the things going on in their life, so they can be pretty locked in the other parts of their life, like their work.
Do investors have control over how much founders pay themselves?
I've never personally, to date, changed the proposed compensation from a founder, because I think that all the founders that I've worked with are pretty reasonable. But there are compensation committees on boards oftentimes to approve executive compensation, including the founder and CEO. Yes.
Have you ever met any founder that does it for the money?
I have definitely met founders that have done it for the money, and I think it's totally fine. A lot of people are like, oh, only back mission-oriented founders, and I'm like, I don't know. Some founders have a deep desire to get rich, and that will drive very, very, very hard. For whatever reason that, you could dig into their childhood and why they need to get wealthy in order, because they think that that's going to bring happiness. But I think it's like one of the many reasons usually why they're doing the thing. But yeah, no, I think some people do it for the money, and that's why all they're doing is like trying to figure out an idea that's going to work in a big market and like hunt after it. But it's a very different mindset than the mission-oriented founder.
How is it different from talking to a mission-oriented founder versus talking to someone that is in it for the money?
Mission-oriented founders might want to, make a certain impact on the world, and they won't be satisfied until then. And so the, common saying is that the mercenary founders will oftentimes give up when the going gets hard, and the missionary founder will drive through because it's their mission in life. And by the way, some mercenary founders who are money oriented are going to want to exit early, is what some people say, right? And sure, if they want $20 million or $50 million, that's what they'll do. But if they only want $1 billion and they want to be a billionaire, like, I don't know, I think they're going to work pretty freaking hard and run through walls too. But, mission oriented founders oftentimes, don't get burnt out as much because like that mission is so deeply embedded in them. More sustaining hunger. Yeah, it's a sustainable hunger more than anything.
Well, why are they hungry?
It's everybody. It depends on the person. I mean, like, think about it. You could have had something happen, like you lost a parent to cancer, and you're developing a cancer drug because you wish that you could have saved your parent's life. Pretty sure that's going to be somebody that's really freaking driven, right? And they're going to get, pushed down, knocked down constantly, and they're probably going to get right back up because it's really important to them that they're going to go ahead and try to do that.
This is, everyone talks about hunger, but no one really. How would you put it as intrinsic versus external factors that drag them?
That drag them into having that hunger?
Yeah.
I think a lot of adversity in your childhood like creates a lot of that hunger. A lot of that. And that's technically external, but external factors, it's like, another way to ask the question is it nature versus nurture? I think a lot of the hunger comes from nurture, but some personality traits certainly do come from nature. But a lot of what happens to you, they say life's like, life's 10% what happens to you and 90% how you react to it. I mean, I think it's very true when it comes to hunger.
Is it nature for you or nurture for you?
It's absolutely nurture for me.
Why?
It's nurture for me in some ways, and it's nature for me in other ways. Like if you talk to people that I grew up with, and you talk to my neighbors, and you talk to my family, I was always like a high energy, curious, extroverted kid. That was probably like nature, in many ways. But, I was sick growing up. My dad worked incredibly hard, and left the house at 5 and came back at 4 to coach our sports teams and like set a really high bar. And, both my parents always treated people incredibly, incredibly well and worked hard to try to provide for my, my brother, my sister, and I. I have had other things pop up throughout the course of my life, like that. I never thought I was the smartest person because I wasn't getting the best grades in class. And I remember when I was sick one time in like middle school and my math grades were dropping, and they were like, hey, like, we think you should go down a math level. And I felt like I was being called stupid. Well, I didn't want to be called stupid. Like, I thought I was pretty smart. And so, like, things like that, push you to be better and better and better. A lot of things throughout the course of life, the little things, add up and really get ingrained in you over time.
You talk about school there. A lot of founders that I talk to have really been against the whole schooling system, and that made them feel dumb rather. Good. What? Why?
I don't know. I mean, look, I never felt like school was gonna like really be the thing that taught me how to build a business. And I was always only interested in the things that I was very interested in, and I had trouble focusing on things that I wasn't interested in. So if that's the case, then I'm probably going to be getting some bad grades. And I went to the University of Miami. I didn't go to Harvard or Stanford or Penn. Am I doing pretty well in my career so far? Like, I think so. And a lot of the kids, who went to Harvard and Penn and Stanford are the people who are like my peers now. But I was not somebody who thought that learning X, Y, or Z thing in the interdisciplinary or cross-disciplinary, learning environment, liberal arts studies was going to make me super happy or be incredibly additive to my life. And, if you don't think it's going to be additive, then you're not going to want to excel at it.
Then why do people not just start closing down schools?
Because there's demand for it, clearly.
Yeah, it has a very high market and very low market risk is what I'd say. I think this will be incredible. I think we'll take a hard stop there. The one question that I usually like to end with, I've been into startups and VCs since 2011. What do you think is one fact that would blow them in your mind?
Oh, man. There are some very, very good companies out there that lose, light on fire, $10 million, $20 million a month. that really, really smart people gave them money to do that. And sometimes those smart people are wrong and those companies don't even work. And so they just burned all that money. That's my fun.
Oh, that blew 15 years. I think this has been incredible. I learned a lot from this about everything. And I think that's it from my side. Anything you'd like to say?
No, I'm good. I appreciate having me on. I hope you have a great night.
Yeah, you do too.
Thank you, man.